Welcome back to The Capital Manager, the show where we look past the hype and dive into the cold, hard truths of the financial world. I'm your host, Alex, and today we are tackling a statistic that hangs over the entire retail trading world: the harsh truth that 90% of Forex traders lose money. And we're going to find out why, and more importantly, how to avoid it.
It's great to be here, Alex. And that 90% figure, it's brutal, but it's real. My name is Dr. Ben Carter. I'm an economist and a financial coach, and I spent years analyzing why so many people fail in what is fundamentally a market of probabilities.
So, Ben, let's start right there. 90%. When a novice trader fails, they usually blame the market. They blame a bad indicator or they think the big banks are out to get them. But your research points to a much simpler and more correctable cause. What is it?
It's brutally simple, Alex. Deficient or non-existent risk management. It's not about having the secret strategy or the perfect entry signal. You can have the best map in the world, but if you sail a massive ship with an empty fuel tank into a storm, you're going to sink.
That's a powerful metaphor. The market as a vast ocean. So, if the charts are our map and our strategy is the rudder, then risk management, what is it precisely?
Risk management is your entire safety system. It's the anchor, the life rafts, and the disciplined route planning. It's the system that ensures when the inevitable market storm hits, which it always does, you survive to sail another day. In short, success in Forex is not about how much you gain in one trade. It's about how much you avoid losing in 10.
Psychological insights. Why we resist risk management. That shift in focus from gain to loss avoidance requires a complete mental reset. And this is where the psychology comes in, right? Because I think the core issue is that risk management is actually counterintuitive to human nature.
Exactly. It forces us to accept a loss before it happens. And for the human mind, accepting a loss is equated to failure, and we're fundamentally wired to seek rapid rewards.
Right. So you open a trade, you have an expectation of doubling your account instantly, and then the trade goes against you just a little bit. And that's where the toxic behavior starts. You hold it, you let it run.
That's the loss aversion bias kicking in. Studies show the pain of a loss is roughly twice as intense as the pleasure of an equivalent gain. So when the price hits our predetermined stop loss, which is our circuit breaker, we refuse to liquidate the position because that means materializing the pain. We prefer the illusion, I haven't lost yet, even while the account is hemorrhaging capital.
I see that play out constantly. The simple rule is, once the stop loss is placed, it's law. You treat it with respect. But there's another mental hurdle you mention: overconfidence.
Oh, absolutely. That's the Dunning-Kruger effect in action. The novice trader wins 3 or 4 trades in a row, and suddenly they're at the peak of Mount Stupid. They genuinely believe they've cracked the market code.
And what's the direct financial consequence of that euphoria?
Over-leveraging. The trader with $1,000 account who risked $10 and won $10 now thinks, if I risk $500, I'll win $500. That disproportionate increase in position size is the #1 cause of ruin. One single significant loss and they're wiped out. That's not trading, that's gambling.
It's the difference between a disciplined capital manager and an emotional gambler.
And that brings us to the mathematical discipline of risk management, the 3 pillars that keep you solvent. The first, and the most sacred, is the 1% rule.
I think everyone should tattoo this on their forehead. Explain the math here, Ben. Why 1%?
It's all about survival in the face of the law of large probabilities. If you risk, say, 10% of your capital per trade, and you hit a streak of just 10 consecutive losses, which even the best systems endorse sometimes, your account is wiped out. You're done.
It's catastrophic.
But if you risk only 1% per trade and lose 10 times in a row, you've only lost about 9.5% of your capital. You still have over 90% left, ready to capitalize on the next opportunity. It shifts trading from a sprint to a marathon. You've guaranteed your longevity.
That's phenomenal. It buys you time, which is the most valuable commodity in trading. So once we have that 1% rule, how do we correctly size our trade? Because that's the second area where people mess up, right?
Absolutely. Novice traders choose the lot size first, then they see where the stop loss fits, if they use one at all. They're driving a car without knowing its safe speed limit.
And the professional approach is the reverse.
Precisely, it's an inverse calculation, a three-step process. Determine the risk, what is 1% of my total capital, say $100. Determine the stop loss, SL, based on technical analysis, where's the level that invalidates my idea, let's say 20 pips. Calculate the lot size. The lot size must be the one that if the price moves 20 pips against you, you lose exactly $100.
That makes so much sense. You're defining the potential loss before you ever enter the market. The loss is pre-calculated and acceptable.
It's non-negotiable protection. And related to this, the worst mistake, the financial death sentence, is moving your stop loss against your position to give the trade more room. You're bypassing your own circuit breaker, inviting a total financial fire.
Let's move to the practical takeaways. How can our listeners, the disciplined capital managers, implement this today? Beyond the 1% rule, what are the next two most important things?
The first is the risk-reward target. You must always aim for a minimum R to R of 1 to 2. For every dollar you risk, you must aim to gain at least $2.
So if I risk 1% of my account, I need to be targeting a 2% gain.
That's right, because mathematically, this allows you to have a winning rate of less than 50% and still be profitable. You don't need to be right all the time. You just need your winners to be significantly bigger than your losers.
That's a huge relief for people who think they need to win 80% of the time. What's the second tip? The tool of choice.
The trading journal. The difference between a gambler and a trader is that the trader keeps a record. It's not just a record of wins and losses, it's the X-ray of your decision-making. You need to be tracking key metrics.
Like what? What reveals poor risk management instantly?
Maximum drawdown. This is the largest peak-to-trough decrease in your capital. If your drawdown hits 40%, your management is disastrous. A professional keeps it below 10 or 15%. Also, the profit factor. Gross profits divided by gross losses. If it's below 1.0, you are consistently losing. You need to be aiming for something greater than 1.7.
So the journal provides the objectivity that your emotional brain is trying to ignore. It forces accountability.
Precisely. And one final psychological safety tip that goes in your journal, the pause plan. Include a rule like, if I lose 3 consecutive trades, I stop trading for 24 hours.
That is brilliant. It pulls you out of the heat of the moment, prevents tilt trading, and forces you to reevaluate your strategy and psychology with a cold, logical mind.
It's the emergency anchor you drop when the psychological storm is brewing. That's what discipline is.
Ben, this conversation has been incredibly clarifying. The 90% failure rate isn't some mystical conspiracy. It's a lack of respect for fundamental mathematical and psychological principles.
It is, Alex. The Forex game is an endurance race, not a speed race. You now know that the loss aversion bias causes you to move your stop loss, that the 1% rule is your protective shield, and that your lot size must be calculated inversely based on your risk and your stop loss distance.
The biggest takeaway for me is the mindset shift from hoping for a win to focusing on surviving the next inevitable loss.
Absolutely. Your control is not in predicting the price. Your control is in defining the risk you are willing to take. We've given our listeners the tools and the expert mindset, the experience to recognize danger, the expertise to calculate risk, and the authority to follow their own plan.
Well said, Dr. Ben Carter. Thank you so much for breaking down the truth about trading survival today.
My pleasure, Alex. Go for sustainable profitability, everyone.
And to our listeners, your next step is practical. Go to your platform or your journal right now. Calculate 1% of your capital.
Starting with your next trade, do not risk a single cent more than that figure. That's your first step towards joining the 10% of profitable traders. We'll catch you next time on The Capital Manager.